Joining us right now is Roger Ferguson. He is former Fed vice chairman, also a CNBC contributor. And Roger, obviously a very hawkish message coming from Kevin Warsh and from the rest of the Fed on this. Is this a situation where you think they are going to have to act quickly on this?
Well, first, good morning. I think they are eventually going to have to act. What I found interesting about the vote was indeed a real lean towards the hawkish side with 3 dissents. What I found interesting in Chair Warsh's press briefing, however, was it didn't sound quite as hawkish in my ears, and I think to others as well. And I think there's a little bit of confusion as to what's likely to happen next. So I think eventually some rate hikes because the data are going to call for it. But I think yesterday there was a little bit of a mixed message that I and others picked up.
What do you mean when you said it's not as hawkish from Kevin Warsh as you had anticipated? Meaning he didn't signal that they're definitely cutting next time around?
You mean they're definitely raising? Yeah, he didn't signal that.
Raising, right.
He talked a great deal about sort of how tightening financial conditions allow them to sit and wait this time around. And to be true to his side, financial conditions certainly tighten even more afterwards. He talked about rate hikes as one of the tools, and didn't say it was necessarily the primary one. So there is some nuanced language there that I would say, and I think markets also would say, called into question exactly how he's going to deliver on these very strong words of being resolute. And I think that's going to have to be clarified over the next period of time.
There are some who have said, look, he wants to be able to say he's got a bazooka in his pocket, and that should be enough to convince markets. You sound like you think he's actually going to have to shoot that gun and raise rates a few times before the market actually buys it.
That's where I stand. Exactly right. We'll see how it plays out. But, as with any other situation, it's to keep saying you're resolute and then to not act, calls into question exactly how resolute you are. As one of his colleagues, Christopher Waller, said, I'm going to paraphrase, inflation's not going to just melt away in our withering glare. I think it's something of that sort that Governor Waller mentioned. And I think that's going to start to play out. So I understand he's resolute, but I think at some point, if you're the Fed, you're going to have to exactly disclose and reveal what your strategy is for bringing some action behind those words. Otherwise, the words will start to sound a little hollow, at least there's a risk that they will.
Time you get up every day, Roger, do you watch Squawk Box? Do you got other stuff going on, or I don't know, you get recipes from some of those other morning shows? Or did you see Stephen Myron the other day? He did this study with Nouriel Roubini, of all people. I thought the Venn diagram of those two would be, something like that. But they're back to monetary theory and back to looking at, the growth of the money supply after the pandemic. Should have been apparently obvious to everyone that inflation was not going to be short-lived. However, they come to a different conclusion about where we are right now in terms of money supply growth, and we're actually neutral. Do you think Kevin Warsh adheres to that? Because there have been people that say it wasn't supply chain after the pandemic. It wasn't this. It wasn't that. It was absolutely too many dollars, chasing too few goods in terms of, how quickly the balance sheet had grown. Maybe this time it is transitory. That's really what Myron said the other day. This time it is transitory, the inflation. But, with 5 years it's transitory.
Well, that's exactly the first to answer your question. Yeah, whenever I can, I do look at CNBC and Squawk Box in the morning. Nothing else with her. But I think you put your finger on exactly what the debate is. And I think the last round of inflation had a number of factors, all of which led to the same issue, right? There was very stimulus fiscal policy. The Fed accommodated it and blew up its balance sheet, as we've talked about. And there were the bottlenecks that came from closing and suddenly reopening the global economy. All of those things were at play. I think the issue at this stage is the Fed's balance sheet is still very large. Most people, many people, and certainly numbers on the committee think that the policy is not in restrictive territory and can cross into restrictive territory. And then we also have, tariffs and oil prices that can continue to be sort of uncooperative, we'll put it that way, on the inflation front.
Right.
So I do think the questions that you're asking are the right ones, and I think they're going to be resolved ultimately with the Fed having to raise rates, even though at this stage it looks as though their chair is sort of resistant even against the voices of many of his colleagues.
During a war, raise rates during a war? I just can't imagine that you'd be haunted forever.
I think the issue is ultimately, fiscal policy is still relatively stimulative. We're going to have to spend more. We see quite a bit of demand for capital coming out of Silicon Valley. Oil prices do not look like they're declining; they look like they're spiking. And the economy is actually doing well, as Chair Warsh said. The economy is showing surprising resilience. So the only thing that's wrong with this picture is they've missed the inflation target for 5 years. And now, they seem, I don't think they're indifferent, but I think there's a dissonance between the words and the actions. And eventually those things are going to have to line up unless they get very, very lucky. And I wouldn't at this stage, while we can hope for luck, I wouldn't bet on or expect that it's going to be, a very lucky outcome for everybody. If they don't take some resolute action to back up resolute words.
Hey, Roger, I guess I would ask when this problem becomes Warsh's. I mean, he's only had 2 meetings at this point. If we have 5 years that this has been a problem, why is this the moment that we say everything has to happen? And I'll point out, Myron added the other day that if the Fed didn't raise rates last time and the CPI numbers came in cooler than anticipated since then, why would they change their mind now?
So I think the CPI number coming in cooler than anticipated set up a hold at this meeting. I think once people saw those CPI numbers, while the expectations for a rate hike were roughly, call it 35%, part of the argument from at this meeting was that CPI had cooled, and it gives everyone a chance to breathe, so to speak. The challenge I think that I'm struggling with here a little bit is, the data may play out in that direction again. But I think what I was missing from Chair Warsh's statement was something beyond the resolute. And so, as I said, the reason he gave for not moving was that financial conditions had done some of the work. That's so far so good, but I think he would lose credibility. And then, he was, to me, a bit tepid on whether or not he'd ever use the interest rate tool as he thought about many other tools. So I think you're right on why September made sense, why July made sense to hold. Where I'm struggling, I think many in the market are talking about confusion, is a little bit more willingness to show action and not just words, and to be prepared to move in September if the data do not unfold correctly. And you can see that he's got a committee that looks to me pretty restive. There are 3 dissents. I could have imagined 1 or 2 other individuals, based on what they've said, who might have been leaning towards a dissent as well. So I think that's the dilemma. And, when does it become Chair Warsh's problem? I think it is Chair Warsh's problem. Once you
but is this an indication that Powell didn't do enough? That we have been out of the reins for 5 years, and so that was a failure on the Powell Fed's part?
Oh, yeah. That's certainly, Joe, and maybe you, Becky, you've heard me often enough that I very much believe that tolerating inflation out of target for 5 years will certainly be one of the things that people talk about when they talk about Jay Powell's term. So I'm not arguing that now it's Chair Warsh's problem, that it wasn't Chair Powell's problem before. It's just the issue is once you take that chairmanship, then I think you inherit, all the problems. And it's a little, one can point to your predecessor, but the markets and your colleagues will be pointing to you to say, okay, if you didn't like the past, are you going to rectify?